During this week, Rupee registered a high of 72.82 on Friday, bolstered by steep gains in the global stock markets and dollar's weakness against the major and emerging market currencies. In the later half of the week, the rupee recovered to touch a high of 73.18 as dollar buying interest emerged at just below 73.00 level, but the steep rise in local stocks on Friday lifted the rupee to end the week a lot higher at 72.82. Exports in April jumped to USD 30.63 billion, while imports rose to USD 45.72 billion, making the trade deficit to widen to USD 15.09 billion against USD 6.76 billion in April 2020. The trade gap was USD 13.9 billion in March. The trade balance report has no impact on the rupee, as the recovery in countries' exports is broad-based and substantial. The government expects the export target of USD 400 billion can be achieved in this fiscal. The local forex market is currently passing through a phase of the recognition gap by ignoring the domestic economic fundamentals and giving more weightage to the rally in global stock markets and the weaker dollar against the major and emerging market currencies. It is only a question of time before the weak domestic economic data like higher inflation, lower GDP growth, coronavirus impact on the economy, and ballooning fiscal imbalance hit the market sentiment to take the rupee lower to test the 73.80 level much sooner than later. Dollar inflows are expected from offshore investors on account of IPOs and QIPs being planned by a slew of Indian companies. The dollar demand from importers and corporates seem to be absent, and quite possibly those entities may be waiting for further strength in the rupee exchange rate beyond the 73.00 strong resistance level. The traders remain wary of RBI intervention if the 73.00 resistance level breaches on a sustainable basis. Based on the firm level of the rupee currently ruling at below the 73 level, some of the currency analysts are forecasting the rupee to weaken to 75 to the dollar by end of the current financial year. Based on the ongoing rupee forecast, the rupee's depreciation against the dollar will be around 2.60% from the closing level of 73.1050 as of 31st March 2021. Quite like the rating and multilateral agencies have revised the GDP growth forecast in relation to the periodical change in the economic scenario sharply from 11.5% to 9%, it is quite possible to expect that over a period of time, The forecast for the rupee may also get revised downward to 76.00, that's 76.30 at the year end. Our forecast for the rupee at the end of the current financial year, after reckoning the various adverse factors which may happen in between the period from now, is quite close to 76.00 level, representing a depreciation of close to 4% on an annualized basis, which is also the inflation differential between the US and India. After weaker than expected US non-farm payrolls data released on Friday last week, the dollar decline continues to benefit the rupee. However, the growing inflationary pressures in the US and recent rise in the global oil prices helped to counterbalance any steep rise in the rupee exchange rate. Moody's Investors Service raised their concerns that in the event of a prolonged and wider lockdowns, it will have a more severe effect on companies' earnings recovery. Starting in early June, the market is discounting progressive lifting of widespread lockdowns. Despite the impact on growth and earnings in Q1, smart recovery can be expected in the subsequent quarters. The significant rise in the prevailing forward dollar premium levels up to 6-month maturities is serving to discourage the importer covering in the market, and the market position is skewed towards lower dollar demand and higher dollar supplies to guide a one-way direction in the domestic currency, and RBI intervention is the only tool available in the current circumstances to maintain normal conditions in the market. The government has set an ambitious export target of $400 billion in FY 2021-22, and hence it is imperative to maintain a weaker rupee to boost export competitiveness. Due to lower demand of petrol and diesel, the oil import bill in the previous financial year was much lower, and the stronger rupee has not effectively helped to reduce the imported inflation. In order to normalize the forwards, we suggest the central bank to permit the specified banks to hold dollars in their nostro account up to an amount of $250 million, with the condition that the dollar funds should not be deployed for lending to corporate entities either as working capital loan or for trade credit facilities. The forward dollar premium received by the banks from RBI for specific maturities would increase the yields on their deployment of rupee funds much above the money market yields available for the corresponding tenor of the swap. Over a period of time, the distribution of surplus dollars with various banks or specified authorized dealers shall bring down the paying pressure in the swap market and normalize the forwards to stay in the range between 4 to 4.5% per annum across the various maturities. We feel our above suggestion is workable, subject to approval from RBI, applicable for a specified time frame.